Thanks for joining our webinar today. We're still getting some people logging in, so we're going to give it just a few more minutes before we get started, and then we'll get this going. Thanks again. Hello everyone, and welcome to the February webinar titled Guidelines for Retirement Planning Starting Early, courtesy of MassMutual Financial Group. We certainly appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly webinar series, and today our presentation will provide an overview of some basic budgeting strategies. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the entire webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then at the end of the presentation, we will take some time to go through these. With that said, I'd like to introduce our guest speaker, Dan Kolosowski, Retirement Specialist at MassMutual Financial Group. Dan has been with MassMutual since 2006 and holds his Series 6 and 63 licenses. Dan also obtained his MBA from the Eisenberg School of Management. Dan covers the West Coast for MassMutual and is responsible for 401k education through group sessions and one-on-ones. We're very excited to have Dan here to share some insight on retirement planning, and I'd really like to thank Dan for taking the time to go through this with us today. With that said, Dan, I'll now turn it over to you.
Great, thanks so much. Thanks so much for the intro. So, as you can see, my last name, Dan Kolosowski, obviously 100% Polish, so thank you for that. But welcome, everybody. I appreciate everybody signing online this morning or afternoon, depending on where you are in the States. But really what I wanted to cover, and I figured because it's the beginning of the year, it's a great time to start planning for retirement, and starting early is key. Ever since I started working in 401ks and retirement planning, the biggest factor with anything is time. And so I'm going to cover some topics in regards to it, and then I'm going to give you a lot of examples throughout this presentation in different ways. So you can see how starting early really helps and how just small amounts add up over time. So first, here's some of the guidelines for retirement planning. You want to take inventory. You want to plan for the long term. Obviously, understanding risk and reward, using different planning and investing tools that, again, Pensionmark has and MassMutual. And then also you want to manage your assets over time. So let me go over kind of each section so we have an idea of what we're going to be planning out during this presentation. Obviously, taking inventory, you want to find out where you stand financially, and that's obviously a really important first step to planning. You want to understand expenses and income and future needs, obviously very important in developing a plan that will meet short-term and long-term goals. So when we talk about long-term, with investing, like I said, time is your ally. So the earlier you begin, the more time your investments have to grow. So since time is an important factor with investing, you really want to develop and adhere to a plan. And then understanding risk and reward, there's obviously a trade-off between the two, and it's really central to investing. So since different investments carry different levels of risk, your comfort level or risk tolerance combined with your time horizon should be the primary considerations when selecting investments. So again, any advisor can go to you and say, you know, you should go into here, you should go into there. Back in 2008, that's what happened, and there's many people who were very worried about how their investments did. And the biggest factor was they're not comfortable with taking that amount of risk. So you really want to make sure you're comfortable and you're explained correctly the ups and downs of whatever investment you go into. And I mentioned another phrase, time horizon. Anytime I do a meeting, anytime I do planning, that's the first thing I ask is, what's your time horizon for retirement? If you hear anything other than that that's important, this is going to be the biggest factor in determining two things, your risk aversity and how much you need to be saving. Obviously, if you're very close to retirement, you need to save a lot if you haven't already, and your risk may not be as high. And vice versa if you're far away from retirement. So time horizon is going to be the most important factor. I'm probably going to bring that up a few more times during the presentation, so just keep that one in mind. And then managing the assets over time. Obviously, circumstances can change. We saw back in 2008 in the housing crisis and gas prices going up for, I think, 32 consecutive days is what I just read. It's really the most important that you investments keep up with any life changes. So obviously, you want to make sure that you're invested correctly. You're not just, you're at least keeping up with inflation, but you're also beating inflation as well. So there's ways to put your plan on like an automatic style of cruise control where you don't have to monitor it that frequently. But it's always a good idea to review your contribution levels, your asset allocation, and your investments at least annually. So I'm glad everybody signed on the phone today because, again, this will be kind of your annual checkup if you haven't looked at your account recently to make sure that you are contributing and invested correctly. So first off, taking inventory. You really want to understand where your money comes from and where it goes. So for some individuals, budgeting may seem simple. You know, you spend money on things that you don't need to spend, or you spend more than you earn. But when you consider all expenses, mortgage, rent, car payments, auto, homeowners insurance, life insurance, credit card, taxes, etc., budgeting becomes extremely complex. So that's why a plan is important. In the end, your budget should take into account all your sources of income and all your expenses, including the amount you save for retirement. So I was recently out with a client. Many individuals were really close to retiring, and they never did a budgeting session. So they really had no idea how much money they needed to save up to cover all their expenses. So that's going to be number one, is make sure you know how much is going in, how much is going out, and what is it paying for. And then your annual retirement need is calculated by taking your current salary, adjusting it for inflation to determine what it would take to continue this level of income during retirement. So most financial experts, advisors, et cetera, myself included, you usually need to replace about 70 to 80% of your pre-retirement income. And typically that other 20 or 30% comes from Social Security. So there's really three main sources of income. I mentioned Social Security is kind of that 20 to 30%, but you may not be able to count on it in the future because really what Social Security is to cover is actually 40%. That's really what the Social Security pre-retirement savings is meant to cover. The reason why I say more in the 20 to 30% range is in the future, it may not be a higher benefit as we're used to seeing, or it may be non-existent. So you want to make sure that whatever you're saving up, you're at least hitting that 70 to 80% income level mark. And if Social Security is there, then that's just an added benefit. But if you have a birthday around the corner or anything like that, typically you'll get a Social Security statement in the mail. So take a look at that. I know that Social Security, they've been sending that information on an annual basis, I think, for at least the last few years. Your company benefits administrator may be able to provide you with a more specific information if you have pension benefits and so forth. And then you also have personal savings, so you want to take into account IRAs, Roth IRAs, 401ks, 403bs, 457, whatever type of retirement plan you have with your company, you want to take all that into account. So again, retirement income, you have Social Security, employer-sponsored programs, so like I said, those 401ks and 403bs, et cetera, and then personal savings. So again, those are those IRAs or even CDs with a bank. And then you want to think about what will your current investments be worth when you retire based on their anticipated returns. So I'm going to provide you with some historical data and in the course of this session, and then we can kind of take a look at what you should be expecting based on what type of risk section you're in. And then after determining your retirement income needs and the sources of income, you will most likely have a much better picture of whether you have enough retirement income to continue your current lifestyle or whether there's a retirement savings gap. So how much do you need for retirement? Obviously, everybody's different. Everybody has a different level of living. For me and for other individuals I spoke with, advisors around the industry since I started, 10 to 15% is the average. Again, you can go on CNBC today, Google Finance, any plan calculator, and you'll normally see that. I'm not sure if anybody on the phone has listened to Susie Orman before, but she's obviously popular, financial and talks about savings and so forth. I was watching her the other day in my hotel room. I travel around the country to provide this education, and she said the same thing: save to 10 to 15% of her paycheck for retirement. And I'm yelling through the TV. I'm like, I say that in every single meeting, but a lot of times I'll say that, and people will just walk away from me. They said, there's no way I could do 10 to 15%. So for me, when I first started saving in my retirement plan, I did 4%. I've heard it time and time again, you got to do 10 to 15%, 10 to 15%, but I'm like, how am I going to get there? You're probably thinking the same thing. Maybe you're only doing 4% right now or even 5%. How can you go from 5 to 10? It's going to take time, and this is the way I structured it for myself, and since I've been doing this and going out and meeting with people one-on-one, I've been having the same strategy employed on their accounts, and they've successfully done it this way. So I started with 4%, and every 6 months, I took a look at my contributions and raised it by 1 extra percent. So after 1 year, I was at 6%, 2 years at 8%, and then 3 years, I was at that 10% level I should be. So again, it took 3 years for me to get there, but the difference out of my take-home pay was maybe 10 or 15 bucks every 6 months. So for me to be accustomed by 10 to 15 bucks every 6 months was much easier from going from 4 to 10% overnight. I'm just going to give you an example. For someone I set up with when I first started, they were actually not even contributing. So I got them at 2%. There's no difference out of their take-home pay. Right now, they're currently doing 15% with this strategy here. Again, just slowly bumping it up each year. So do what's comfortable for you. Again, put as much as you can out of your paycheck, really until it hurts, but at least put something. So again, if you can only do 4%, do it. Most plans allow you to change contributions sometimes every paycheck or sometimes every quarter, but just kind of use something like that at least every year or every 6 months to get to those 10 to 15% levels. So I want to talk about effects on your take-home pay. A lot of individuals that I speak with who haven't started a 401k plan before will normally have something with a bank, whether it's a CD or some type of money market account or something like that. And really I tell them the major benefits of a 401k or 403b or whatever your retirement plan is through your company. So with the pre-tax portion of your company-sponsored retirement plan, you're going to be really saving that tax up front. And if you're not going to retire for 10, 20, 30 years, well, that's technically 10, 20, 30 years of tax savings. But obviously, you have to pay that later on at retirement. But the idea is you're in a lower tax bracket. But let me give you a quick example with the net take-home pay differences. So if you're saving, if you're making gross monthly pay $2,500 bucks, take 6% pre-tax contribution, it's $150 out of your paycheck. Look at the taxable amount. So the government's only taxing you on $2,350. I know tax time is right around the corner. Everyone's going to be filing pretty soon. If you have been contributing to your retirement plan, take a look at your wages for the year, your W-2s. Then take a look at what you've contributed to your company-sponsored plan. The government's going to tax you on what's left. So in this example, that taxable amount, it's only taxing you on $2,350. So income tax, $353. And then the net take-home pay is $1,997. Now let's look on the flip side if it's an after-tax deferral. So meaning if you save with a bank or anything like that, this is money you pay taxes up front. So you make the same amount, $2,500. Your taxable amount, again, you're taxing that full $2,500. The income tax is $375. So because they're taxing you obviously at a higher level, they're going to be taking more taxes out. Now your 6% contribution is going to be the same because technically it's 6% of your $2,500. But take a look at that net take-home pay, $1,975. So there's obviously a difference right there, right? You can either have $1,997 in your pocket or $1,975, but you're still saving 6%. But the net take-home pay is actually larger because you're saving in that pre-tax portion. So if anybody on the phone hasn't started saving in their retirement plan yet, this is one of the major benefits. This is the reason why it started, is because of these tax benefits. Again, I'm going to go over investments a little later, just briefly. But even if you're in one of the safe options that are in the plan, like a money market or one of the fixed bond options, at least right up front, you're getting an automatic tax savings. So take a look at that on a monthly basis, a yearly basis. And then if you get 20, 30 years into retirement, imagine saving 20, 30 bucks either every week, every month over the course of the 20, 30 years. That's a lot of money pre-tax that you'll be saving that you could put to something else. So what can you do with the extra money? A lot of different things. So take a look at that, and this is going to be the major reason why to save in a company-sponsored retirement plan. And then you also want to plan for the long term. So I mentioned that earlier. You want to take a look at outliving assets, future income projections. Take a look at the present annual income on the left-hand column. Then take a look at the middle column, equivalent annual income after 30 years. And then annual income needed for retirement, and that's at 80% pre-retirement income. That's how much you'll need. So take a look at what you're making today. Maybe you're in one of those blocks there in that column. In 30 years, really, the equivalent annual income needs to be what it is in that middle column. So if you're making $20,000 today, you really need to be making $48,545 in 30 years, just based off inflation, nothing else, just inflation. And the annual income you need for retirement, if you're going to use that 80% calculation, is $38,836. So the biggest thing to ask yourself is, well, how much money do you need? So obviously that's going to depend on current income, on your lifestyle, and plans for retirement. So like I said, take a look at this example. This is a 3% inflation annually. And obviously income will have to rise significantly to replace your current buying power. So plan early. Make sure your investments are allocated correctly because inflation is always eating at your money. So there's really two things. It's inflation and taxes. Those are two things that are always eating your money. That's why you want to make sure you're planning correctly to account for things like this. Now, dollar cost averaging, this is another technique when you start early to employ right off the bat. And this is why I have it kind of early in the presentation, because when you're saving in a retirement plan, not so much a self-directed brokerage account, you know, if you have stocks or anything like that in the outside, this usually does not work. With stocks, that's something you have to analyze really on a regular basis. But for mutual funds, long-term investing, retirement plans like this, dollar cost averaging is going to be a really, really big factor. And really what dollar cost average is, it's investing the same amount at regular intervals, or every month for this example, and it's known as a systematic way of investing, or dollar cost averaging, as I just mentioned. So it's a good way to work toward long-term goals. So dollar cost averaging has historically worked especially well in volatile times. So take a look back in 2008. Making investments of a fixed dollar amount at regular intervals buys more shares when prices are lower, fewer shares when prices rise. So over time, dollar cost averaging may lower the average price per share paid and can help smooth out the effects of volatility in a portfolio. So again, in this hypothetical example shown in this slide, the lump sum investor paid an average of $10 a share, while the one who bought shares monthly paid closer to $9 a share. So that may seem like small numbers, but it's going to have a huge impact over time. So systematic investment plans, such as dollar cost averaging, do not ensure a profit or do not protect against a loss in declining markets. So again, you always want to make sure before investing that you should evaluate the long-term financial ability to participate in such a plan. But really what this does is allow you to get out of a negative return faster. If you take a look back in 2008, if you were investing there in that time, guess what you're doing? Buying investments on the cheap. When the market went back up, Now, technically, you're buying less shares because they got more expensive, but guess what you just did in 2008 when the market was low? You were stacking the shares of the mutual funds up in your portfolio, so that really meant that the portfolio didn't have to jump back 100%. If you lost 50%, it's got to jump 100% up on the turnaround. It didn't need to do that. So dollar cost averaging, look at this slide here. I'm going to have another example on this to give you a visual in two different ways. But if you take a look at this, investing $1,200 all at once, or $100 a month for 1 year, look at the shares at the end, all the way on the right. If you were to invest it all in once, you have 120 shares. Or if you're going to do the dollar cost averaging method, you actually have more shares for the same amount of money that you save for the year. But because of the dips in the market, you took advantage of that. And then here's that second example that I wanted to tell you about dollar cost averaging. I like to have it a few different ways because if you've never heard about this before, most companies will do this for you automatically. So typically a company, when they take money out of your paycheck for the retirement plan, they're going to take it out whether it's weekly, biweekly, semi-annually, semi-monthly, or monthly. They'll usually input that into your 401k or 403b, usually within the next week. So it's an extremely quick process. Once it's taken out of your paycheck, it's then sent to the financial institution to invest in your 401k or 403b. So when you take a look at this, they're doing it for you automatically. As long as you're saving out of each paycheck, the company is employing this strategy for you automatically. You may not even know it. The only time that you want to maybe do this on the outside where it isn't automatic is typically like an IRA, like your individual retirement account, or maybe something if you have something with a bank. This is something where you want to employ, whether it's a monthly allocation if you have an IRA, set up some type of automatic investing. I do the same thing in my IRA. I make sure I have it set up on a monthly basis at least. Maybe I'll break it down maybe twice a month or maybe just once a month depending on what I want my frequency to be. But if you take a look at this example here, this is investing $100 per month, and the total investment is $600. And if you take a look at when prices increase, when prices rebound, and prices decrease, what the average cost per share is. So take a look at all the way to the right, and you're going to see in the last two columns on this slide, average market price per share, and then your average cost per share. So guess what? By employing this strategy, the dollar cost averaging, take a look at the average market price, and then take a look at your average cost per share in each column there, in each row. For when prices increase, your average market price per share is $15, but your average cost is $14.20. If prices rebound, the average market price is $7.67, but your average cost is $7.06. Same thing goes for if prices decrease. The average market price per share is $6.50. Well, your out-of-pocket average cost is $5.80. You may not think that's huge, but if you're saving for 10, 20, 30 years, this is going to be extremely significant. So again, take a look at this because not only are you averaging your cost to be lower than the average market price per share, but you're also increasing the amount of shares that you can get during that time frame. So hopefully these two examples help kind of visualize how dollar cost averaging works in up markets, rebounding markets, down markets, etc. And again, something that your 401k or 403b plan is doing automatically for you. Now, another thing that you may have heard in the past is automatic deferral increase. Some plans may label it ADI, or automatic deferral increase. So this is something where you can set up within your account, or just something that you put a reminder in your Outlook calendar or Gmail calendar to increase your contribution by either 1 or 2%. So I had my plan in the beginning, raise your contribution 2% each year. That's what I did. I made sure I automatically did it, at least in the beginning of the year or some way in the midpoint of the year, to increase my contribution. So if you take a look at this, a portfolio valued at $0 at the beginning of 1 year, someone's salary is $50,000 in 1 year and increases 3% at the beginning of each consecutive year. So beginning contribution rate of 5% in year one, and an annual increase of 1% at the beginning of each consecutive year up to a max contribution of 10%. So that's where they stop. The average annual rate of returns is around 8%. And if you kind of take a look at the history of the bond market over the last kind of 20, 30, even last 80 years, the range has been around 6 to 8%. And again, this example is with no withdrawals taken. So if you take a look at the chart, at this bar graph here, you're going to take a look at years participating in the plan, 10, 20, 30, 40. Here's the value of the 5% contribution. You see at 20 years, and again, the gray part is that 5% contribution. You see that the contribution almost doubles because of that automatic deferral increase amount. And again, they're only increasing it 1% at the beginning of each year up to a max of 10%. So doing the ADI at least once a year, maybe every quarter, maybe every 6 months, is going to help extremely if your plan has it built in where you can just click a button and do it. Trust me, I've done it in my account, I've done it with other people, and I'll call them up after. I'm like, oh, did you notice the increase out of your paycheck? Like, I didn't even know increase was happening. But it's already happening because they already had it set up. So I'd say 90% of the time you'll never notice that 1% increase over time. I'm just going to give you a personal example. I have family back in Massachusetts, and I went to visit. My dad has a 401k plan. He's been working for the company for maybe 20, 30 years. And he has a 401k plan with his company. He's doing 12%. So I think he was doing 10% maybe a few years ago. I bumped him to 12, and he was pretty comfortable with that. So I go back home, and I asked him, well, how's the contributions doing? He's like, you know what, I think I want to increase it, maybe just 1 extra percent. I was like, okay. And how about 14%? Can you do that? Can you do 2? He's like, I really can't do it. So I was like, okay, I'll go in and I'll make the change. And he's like, oh, so did you put it in 13%? I said, sure. I actually raised it to 14% without him knowing. And then I called him about a month or 2 later. I said, how was the difference out of your take-home pay? He's like, I didn't even notice it. I bumped him up 2%, and he didn't notice that. So obviously, I'm kind of going against what he said, but it was my point. I wanted to see if he did actually notice that 2%. I'm only helping him for the future. And really, when I took a look at that, I was like, this is the best example. Is again, he didn't even notice it. Again, don't go too far where it's going to hurt out of your paycheck. So like I said, if he did notice it pretty extremely, I would obviously jump it back down. But that's the thing. If you don't notice it, just keep going, and then you get used to it. So that's the way I employed my strategy with myself. Again, I forced my dad to do more than what he should, and he didn't even notice it. So if you at least do the 1% each year, you're not going to notice that difference. And sometimes the extra taxes that end up coming out of your paycheck, if you get like a pay increase or something like that, it actually usually negates the extra taxes that normally come out. So going on how it pays to start early, I'm going to have a few examples on this as well, because since I started with retirement planning and doing this on a regular basis, I meet with people every single day. I talk to people on the phone lines. I used to work in the call center as well and used to do planning on the phone and set up the individuals through retirement. And the biggest thing I saw was saving early. And people always told me, oh, you know what, if I was back in my 20s, I wish I started in my early 30s and even early 40s. I've talked to several people starting late 40s, early 50s, even 60s. Very close to retirement. And they said, I'm not sure why I never saved. Either thought Social Security was going to be there or whatever. But take a look at this. The 2 different saving examples that I have here. And you want to take a look at the ending balance and how drastic this is. So savings example, both individuals save $2,400 annually. The first individual saved annually from age 30, and the retirement plan savings at age 65 is $276,337. Someone who starts at age 40, $2,400 a year, $136,023. The total difference between the two, just because of that 10-year gap, is $140,000 plus. That's a significant amount of money just on that decade. And again, that's only $2,400. Many people I talk to are saving at least $3,000, $4,000, $5,000. Sometimes if your company has a match or a profit sharing or some type of other cash balance type plan, that's usually double. So the effects are even more. So if you're not saving and you're not getting a free company match or whatever it might be, this total difference could be exponentially greater. I'll give you one more example as well, a 20, 30, and 40. So look, if you're age 20, $2,400 a month, over $500,000. Just on the 10-year gap, if you start at age 30, like I said, $276. And if you're age 40, again, $136. Look at the difference between each decade. Drastic differences. So time is the biggest factor. You want to make sure you're saving as early as possible. Even if it's only a few percent, at least put it in if the company has a match. Don't walk away from free money. I told you Susie Orman said to save about 10 to 15% for retirement. If you've heard her say that before, again, she said it probably every program I've ever watched her on. You know, the second thing she said that I thought was pretty important, don't walk away from free money. If a company has a match, at least do the minimum with a match. If it's 2%, 3%, 4%, whatever it is, at least do that. I'm telling you, the savings examples that I'm showing you here are going to be exponentially greater if you take advantage of that if your company has it. If your company doesn't have a match, well, then you should be saving even more for yourself, because then that means you're not getting extra money. And we don't know, like I said, what Social Security is going to be. So you want to make sure you put in as much out of your paycheck as possible to make sure you have a decent balance for retirement. Hopefully these two examples kind of give you a good visual on what the ending balance could be just based off of $2,400. Again, you don't have to do a lot of money out of your paycheck for it to add up over time, but I'm going to have a few more examples to really embed that, this example to you. So I'm going to skip ahead here and go to why start now once that goes through. So starting now can obviously help make retirement affordable. I talked about the other one. I have 3 different investors. Well, here's a different scenario that I give to most of the presentations that I do when I go out. A lot of clients are either new or it's a new workforce and they maybe never had a 401k plan before. So I have 2 investors, right? Investor A and Investor B. So if you take a look on the left one, Investor A invests $100 a month, or, you know, that's just $25 a week. And if it's pre-tax money, $25 is probably maybe $15, $20 really net take-home pay difference, because you end up saving like $5 or $10 in tax. Investor A invests $100 a month from age 25 to 35. That's it. He only saves for 10 years. $12,000 out of pocket. Look at what his ending balance is at retirement, $185,320. All right, that's just $100 a month for 10 years, $12,000 out of pocket. Look at Investor B. If that's the same amount of money, $100 a month, but he starts at age 35, stops contributing at age 65. You see what his total investment is? $36,000. That's how much he has to put in out of pocket. So really 3 times the amount. See what his ending balance is? $150,030. He not only started a little later, but he invested 3 times the amount out of his paycheck to get a less amount at retirement. So this is the biggest thing to show you is by starting early. And even if you stop midway through because you got family, mortgage payment, whatever it is, you know that you've already planted it early. You planted that money early, and that compound interest over time is just building and building. So I just mentioned compound interest. That's actually going to be my next topic there I'm going to cover for everybody. So power of compounding. Take a look at this example. It's a little busy here, but I just want to show you after 1 year, 3, 5, and 10 years how the money adds up over time. So if you take a look at this example of investing $1,000 after the first year, the investment earned a 6% rate of return or $60. So leaving that original $1,000 plus the additional income over 3 years at the same 6% rate of return turns the original principal into $1,191. Keeping everything constant for up to 5 years adds up to $1,338. Then after 10 years, the original amount has nearly doubled to $1,790. So keep in mind, this example invested $1,000 and left it alone for 10 years. Just imagine what would happen if you were to regularly add income and more money to that principal. So this is just letting money sit there and just letting it earn interest over time, just 6%. 6% return, I mentioned bonds over the last 20 to 30 years. That's been the average range, has been 6 to 8% over the last 20 to 30, even last 80 years, even before Great Depression, about around 6 to 8%. And what about inflation? I talked about this earlier, right? What does inflation ever help you out? Really never does. So you want to make sure that when you're saving, you're keeping that money allocated correctly, and this is why I want to go back to it, because I talk about compound interest and everything else. You want to make sure you're saving at least in a well-diversified portfolio that you're comfortable with to make sure that you beat inflation. So if inflation's 3%, that $20,000 that I mentioned earlier can accumulate to at least $48,000. You're putting it in something that's earning a regular interest rate, whether it's something, a fixed account, whether it's something else. If you take a look right now at CDs with a bank, they're doing around plus or minus 1%. money markets, I believe, are hovering around 0 to 0.5%, something like that. You want to make sure if you are saving within your company-sponsored retirement plan or an IRA, you're invested in something that can at least keep up with inflation. CDs right now are not keeping up with inflation. Not to say that it's a bad investment, because it's a great investment. You need something kind of very short-term and liquid. But for actual retirement planning and long-term, you want to make sure you're saving enough to beat this average of 3%. And 3% has really been the range of inflation over the last, like I said, I always say 20 to 30 years. Over 10 years, really since over the last 80 to 100 years, it's been around 3%. And then I talk about compound interest, right? Let me give you a real example of the S&P 500. And I'm going to show you how growth of $10,000 has been since 1980. So if you dropped in 10,000 bucks in the market in 1980, what is it going to look like at the end of 2011? Unfortunately, I'm not able to get the 2012 numbers yet. They weren't officially released and compliance approved yet, but I have 2011. Keep in mind that these numbers will be greater, though, once I factor in 2012, because it was a highly positive year. But if you take a look at 1980, and take a look in each section, all the stuff that happened, all the economic changes, U.S. becomes a debtor nation, the Challenger disaster, insider trading scandal. You look in the 90s, we had various wars, Russian bond defaults. Look at the new millennium, crash of the dot-coms, the World Trade Center, corporate accounting scandals and so forth, Enron. You take a look at all this stuff that's happened in the stock market during this time. If you take a look at 1980 and then you look all the way at the end, if you stayed in stocks, so again, your S&P 500, your top 500 traded companies, 284,353 is what the ending balance will look like. Now you'll see an example below it, right, moving to T-bills and bear markets. Typically what investors do in a down market is sell out of their investments and then jump back into the market when the market goes back up. What happens? Well, look at the ending balance there, $160,000. So just by an individual moving out of the market, then getting back into the S&P 500, then moving out when it goes down again, then getting back into it when it goes up. This is the difference. $284,000 if you stay in the market, or $160,000 if you get out, move back in, get out, move back in. You can do a Google search on your own as well if you kind of want to do some side research and everything. Type in the average investor return in the S&P 500 over the last 20, 30 years. You're going to see around 3 to 4%. You know what the average of the S&P has been over the last 20 to 30 years? Around 8 or 9%. So if the average investor in the S&P 500 is only getting 3 or 4%, what's the problem here? It's this example right here. They jumped out of the market when it went down, and they got back into it when it went up. Again, I mentioned this before about dollar cost averaging. When the market goes down, you're getting more shares for your money. So back in 2008, I lost 51% of my account. All right, this is exactly what I got. I'll show you a screenshot of my account. 51%. I was buying investments for 50% discount. About midway to the third quarter of 2009, I made back everything that I lost because I continued my investments during that market downturn. What was I able to do? Buy more shares at a cheaper price and gain more income during that 2009 period because the market didn't have to go back up 100% to gain back everything that I lost. This example right here, again, this is real world numbers. This is not some hypothetical situation. This is taking a look at the S&P 500, dropping the money in 1980. What does it look like after the beginning of 2012? 284,000 bucks, just letting it sit there over time. So hopefully that example helps kind of visualize how that all looks. And then I want to kind of wrap it up with a few more things about inflation and show you how this really adds up over time. 4% inflation rate, and this is a little higher, but the range of inflation has been 3 to 4%. That's the typical range. But take a look how $1,000 decreases over time. So while inflation rate has recently been more to 2 or 3%, like I said, it's kind of varied considerably throughout the years. So as you develop and refine your retirement savings plan, keep in mind that inflation can potentially spike substantially in the short term. So again, to give you this example, assuming a 4% inflation rate, $1,000 today would be worth $676 in 10 years, or $456.20. And if you take a look at the end, $308 in 30 years, or $208 in 40 years. So as you can see from this example, the further you are from retirement, the more inflation can reduce your future purchasing power. And it's really more important than ever for you to make sure that the investments that you choose can potentially help you stay ahead of inflation. So again, I kind of want to drive this home to make sure your investments are appropriately allocated to defeat this, to defeat inflation, eating at your money year after year. So we got a lot of people on the phone today. There's got to be at least a few out there who drink coffee on a regular basis, whether it's Starbucks or something like that. I travel all over the country, and to stay awake, sometimes I just need a kick. Starbucks is pretty much everywhere. It's almost at every single corner. And when you take a look at it, normally you're spending about $5 or $10 when you walk out of there, whether it's a cup of coffee and a pastry or something like that. So I took a look at it, and I said, you know what, how does $10 a week add up over time? For an individual saving for 10 years or 20 or 30 or 40 years, how does this look like? So let's take all the way to the right side of this graph here at the 40-year mark. Take a look at that. About $21,000 out of pocket is $10 a week over 40 years. If you take a look at it, what it looks like, if you invest it regularly in a 6% rate of return, almost $83,000 at the end of that time. So your money almost quadruples at the end of 40 years just by saving it in something somewhat conservative. Even at 3%, even if you're putting it in something that's just keeping up with inflation, that $21,000 can be just under $40,000 after that 40-year period of time. That's just $10 a week. Who knew $10 a week can add up to be about almost $83,000 just by regularly doing it? Again, your dollar cost averaging systematic plan week after week, $40 a month. If you can afford to do something like this, imagine what bumping it up another $10 year after year is going to look like. These numbers, these 40 years and even 30 years numbers, will look exponentially bigger the more you save over time. But this really goes to show you that you don't need to put hundreds of dollars out of your paycheck for it to add up over time. Normally when I do presentations around the country, this is one of the first slides that I start off with, because I get a lot of people wondering, I don't have $1,000 to put in my 401k plan or my company-sponsored retirement plan. I'm not even going to do it. At least put in $10 and look how it adds up over time. It's extreme growth just based off on a small amount. And then you always hear the rule of 72. And really the rule of 72 helps you calculate the length of time that may be necessary to double an initial investment. So let me briefly talk about how the rule works. I know you've probably heard this before, but if you haven't yet, divide 72 by the investment's potential rate of return. So for example, let's say you have assets invested in a hypothetical 5-year CD and it yields 1.6%. With the rule of 72 applied, your initial investment would double in 45 years, assuming all earnings are reinvested, because 72 divided by 1.6 equals 45 years. So by comparison, money invested in a hypothetical mix of stocks and bonds with a return of 5%, very, very modest, could double in just 14.4 years. So 72 divided by 5, 14.4. So this rule can be helpful to compare hypothetical rate of return and the number of years it would take to double an initial investment, assuming you reinvest all earnings. So again, that's the rule of 72. I'm sure you've heard that before. But just to give you an idea, and again, you could take that down. If you do have CDs or anything like that on the outside, at least this will give you an idea how long it would take for you to double that investment. And then really to wrap up, I want to cover the 2013 IRS tax limit. So this is something that changes usually year after year. And for 2013, they actually raised the limit that can come out of your paycheck. So the combined contributions that come out of your paycheck for 2013 is limited to $17,500. So if your company-sponsored retirement plan, where it's a 457, 403B, or 401K, and again, those are just tax codes depending on the type of organization you work with, $17,500 is the amount you could put out of your paycheck. If your company has a pre-tax or a Roth as well, I know some plans also have a Roth source built into it. Those are the combined contributions. So if you do a mix of both, the pre-tax and the Roth sources, the total again out of your paycheck is $17,500. If a company has a match, that can go above and beyond the $17,500. So if you decide to max out at $17,500, let's just say the company has like a $1,000 company match, well, you can put in your $17,500 out of your paycheck, and the company will input their $1,000. So really, you're putting $18,500 within your retirement plan. But as for contributions out of your paycheck, you're still within the IRS tax limit. If you're 50 or older in 2013, you can contribute what they call a catch-up contribution of an additional $5,500 above the normal plan and legal limits. So these are very, very high limits to put in the plan. take advantage of what's there. Like I mentioned earlier in this presentation, you don't have to put in a lot of money for it to add up over time, but have that systematic way of investing to make sure you continuously increase that over time. I'm going to kick it back to our host, and I want to talk about Pensionmark and where you can find them online. So you can like them on Facebook, facebook.com/pensionmark. You can also follow them on their individual Twitter page, twitter.com/pensionmarkindv, or you can follow them on LinkedIn, and Pensionmark Retirement Group is the company name. So I'm going to kick it back and also open it up for any questions out there in the field.
Great, thanks, Dan. That was good stuff. Thanks for a little shout out there at the end too. We haven't gotten too many questions in here yet, and a couple of them we actually kind of already addressed as you were going through this, but I'll read them to you anyway. First question was, what is the maximum contribution percentage per year? So I don't know if you want to take that one. I know you just went over that it's $17,500 for the year. I guess I'll just take it since I'm here. And also, it kind of varies by plan. Some plans have a maximum contribution percentage per paycheck. Some don't. So some plans you could actually contribute your whole paycheck as long as you don't go over that $17,500 limit annually. Another question that came in was if you're kind of late to the game in contributing to your 401k, is there kind of a standard rule of thumb for how much you should be contributing to get caught up? Dan, you want to take a shot at that one?
I'm sorry, my phone actually cut off on that moment. Can you repeat that really quick?
Yeah, the question was, this participant was a little bit late in getting started on their 401k, and so they were wondering if there's kind of a rule of thumb for catching up, or if there's kind of a magic number for how much they should be contributing, assuming that they're a little bit late to the table.
Now, this is going to vary, obviously, depending on whatever situation you want to take a look at. If you are late, you may have to play a little bit of a catch-up. Typically, what I recommend people is either going on to whatever online account you have, or checking out the Pensionmark website, or calling one of the individuals on their team. I have the slide open as well. Take a look at what you make on a regular basis. So if it's $1,000 a month, let's just say, really what your goal is for retirement is to replace that income each month into retirement for the 20 or 30 years or whatever you decide to retire with. So if you're a little late to the game, what you may need to do is play a little catch-up. So maybe if you start at, let's just say at age 20, maybe 5% contribution out of your paycheck would have gotten you that income replacement at retirement. Maybe if you're age 30, you would have to do now 7%. Like I said, it's going to be extremely different based on your age, how long you have into retirement, and how much income replacement you need. So there's no magic number for that. But your best bet is to take a look at your current income and do the calculation on what you'll expect to have, or what percent you need to do out of your paycheck to get that income replacement. Whether it's half of your income you can replace at retirement because you have a spouse and they're going to cover the other half, or if it's the 70-80% that I mentioned during the presentation, which is typical, it's going to vary. So my best suggestion would be to speak with someone, either with MassMutual. Again, I have the Pensionmark information on there. Highly, highly suggest speaking with them as soon as possible. Don't wait on that. Trust me, every year and every month you wait, even if there's a company match, you're just losing out on free money. And another thing that what it's going to do is going to kick up the amount you have to do later on. So I mentioned I went out to a company a little earlier this year. Most of the people never started their retirement plans, or they're already in their 50s or 60s. A lot of them, to even get somewhat of a retirement, are almost maxing out their contribution out of their paycheck. So they're getting to that $17,500. And again, wages are pretty normal. You know, they're making around $40,000, whatever it is. So it's a significant amount out of their paycheck that they have to do. If they started even just 10 years ago, they wouldn't have had to do anything like that. So again, kind of a long answer to more of a simple question. I speak to one of our specialists at Pensionmark or MassMutual, and we can definitely walk you through to see what might be best for you in your specific situation.
Great. Well, I think that about does it for the questions. Again, thank you, Dan. And if anyone else does have anything else that they'd like to request from us, our information is up on the screen. Feel free to give us a shout, and we'd be happy to work with you. So thank you all for your time, and we look forward to working with you all in the future. That concludes the webinar for today.